Hey guys, welcome back to another episode. In this video we will be going through our top 3 best oscillator indicators trading strategies in depth and how we use these indicators in combination with price action. As usual, we'll have plenty of practical examples. The idea is to fully understand these wonderful trading indicators. If you want more videos more often, please smash the like button, subscribe, and turn on the notifications bell, and share this video across your WhatsApp, Facebook accounts, or Twitter to show your support. A very important point before we start. Everything we discuss in this video can be used for currency trading, stock trading, and crypto, because price action stays relatively consistent across different assets, so we're going to go very in-depth in this video. Top 3 best oscillator indicators to find high probability entries. When it comes to trading and technical analysis, oscillator indicators are considered to be a cornerstone for evaluating a currency pair or any other asset class. By using an oscillator indicator, you can figure out if an asset price is going up or down as well as how fast it is going in that direction. Market analysts have developed a number of popular oscillating indicators. But not all indicators are created equally, and they all have different functions to provide a varied level of information to traders. So, if you are wondering what are some of the best oscillator indicators available, and which one would help you yield the best results, then, in this video, we have compiled a list of the top 3 indicators that you should try out. Number 1. Stochastic oscillator. How does the stochastic oscillator work? Classically, stochastics oscillator are represented by 2 moving curves that move between 2 levels. Usually, these are 80% and 20%. The solid red line in the stochastics oscillator is called %K, and the blue line is the 3-period moving average of the %K curve. When 2 lines are above the upper level of 80%, marked with blue zones at the top, the instrument is overbought. When they fall below the bottom horizontal line of 20%, red zones in the bottom, it's oversold. When it trades above the 80 level, some traders believe that it indicates that the bullish trend is likely to lose momentum. However, a look into the stochastic formula confirms that a high stochastic shows, in fact, a likely continuation. So, the best way to find a market entry with the stochastics indicator is looking for long entries after a temporary bearish retracement during an uptrend, and a short entry after a bullish retracement during a downtrend. It may sound too complicated at first, especially if you are new to technical analysis and have little experience with trading divergences. In this video, I've included a template of the auto trendline and stochastics oscillator trading system that you can simply upload to your chart, and it will automatically plot all these indicators perfectly on your charts, so there's nothing for you to worry about. Get the download link on the description. And here are other examples of the stochastics oscillator trading to fully understand this wonderful indicator and to make the most out of it. Number 2. Relative Strength Index, or RSI. Relative Strength Index, or RSI, is a popular indicator developed by a technical analyst named J. Wells Wilder that helps traders evaluate the strength of the current market. RSI is similar to stochastic in that it identifies overbought and oversold conditions in the market. It is also scaled from 0 to 100. Typically, readings of 30 or lower indicate oversold market conditions and an increase in the possibility of price strengthening or going up. Some traders interpret that an oversold currency pair is an indication that the falling trend is likely to reverse, which means it's an opportunity to buy. Readings of 70 or higher indicate overbought conditions and an increase in the possibility of price weakening or going down. Some traders interpret that an overbought currency pair is an indication that the rising trend is likely to reverse, which means it's an opportunity to sell. Here are other examples of the RSI overbought and oversold trading. In addition to the overbought and oversold indicators mentioned above, traders who use the Relative Strength Index indicator also look for centerline crossovers. A movement from below the centerline or 50 line to above indicates a rising trend. A rising centerline crossover occurs when the RSI value crosses above the 50 line on the scale, moving towards the 70 line. This indicates the market trend is increasing in strength and is seen as a bullish signal until the RSI approaches the 70 line. A movement from above the centerline or 50 line to below indicates a falling trend. A falling centerline crossover occurs when the RSI value crosses below the 50 line on the scale, moving towards the 30 line. This indicates the market trend is weakening in strength and is seen as a bearish signal until the RSI approaches the 30 line. Here are other examples of the RSI centerline crossovers trading. Number 3. Moving Average Convergence Divergence, or MACD. The two lines of the MACD represent a 12-period exponential moving average or EMA and a 26-period EMA. When the shorter period EMA crosses the longer period EMA, it signals a change in trend, just like a typical MA crossover. But what makes MACD truly stand out is the histogram that measures the distance between these two EMAs. When the histogram is above the zero line and increasing, it signals an uptrend that is gaining momentum. On the other hand, when the histogram is below the zero line, it signifies that the downtrend is gathering strength. Unlike the stochastics, RSI, or CCI, there are no predetermined overbought or oversold levels in the MACD oscillator. However, the trick is to compare the highs and lows in MACD to price action in relation to previous high and lows. In doing so, you can easily find convergence and divergence. The best way to use the MACD to find a market entry opportunity is to be a contrarian. It means looking for long opportunities when the MACD signal line is way below the zero level and produces a buy signal. By contrast, you should look for a sell signal when the MACD signal line is trading far away above the zero level. And, if you find a divergence, it will only improve the chance of a win, as demonstrated in this example. In this video, I've included a template of the MACD trading system that you can simply upload to your chart, and it will automatically plot all these indicators perfectly on your charts, so there's nothing for you to worry about. Get the download link on the description. And here are other examples of the moving average convergence divergence trading. Oscillator indicators are great at finding direction and measuring the momentum of the directional movement of asset prices. But using a single oscillator to find market entries would be too aggressive for even the most experienced technical traders. Instead, we recommend that you combine one of the top 3 oscillators we discussed above with price action, either breakouts or candlestick patterns, to confirm before placing any orders. As always, if you learned something new, or if you want more videos more often, make sure you subscribe, click the notification bell, and share this video across your WhatsApp, Facebook accounts, or Twitter to show your support. See you next time.